Tax filing season is just around the corner. This has never been anyone's favorite time of the year, paying taxes, but the uncertainty created by the current partial government shutdown has understandably created a bit more angst than in a usual tax filing season. The Treasury Department and the IRS have been proactive in taking steps to minimize the burden of the shutdown on taxpayers. They recently announced that tax season will start as planned on January the 28th. The IRS has confirmed that taxpayers can expect refunds to be sent out as usual should this slowdown drag on. And of course, this is the right conclusion legally and the right call for the taxpayers. And I had an opportunity to tell IRS Commissioner Reddick when we spoke recently. Congress has explicitly provided for a permanent appropriation for the IRS to pay tax refunds. This makes common sense. A tax refund represents the taxpayers' money, not Congress's, not the government's, but the taxpayers, despite what some people in Congress seem to think, that this money belongs to the government. But it should be returned then in a timely fashion, and thank God with their decisions, that's going to be the case. With around 75% of individuals receiving a tax refund on an annual basis, many have come to look to their refund to make important purchases, whether that's to replace an old water heater, make a down payment on a reliable vehicle to get them to work, or just to make ends meet generally. It would be wrong for the government to impose undue financial strains on families across the country because Congress and the President can't get their act together. As we continue to work through our differences, and there isn't a lot of work being done on that I can see, and that's why the shutdown is historically long now, the least we can do is return taxpayers their own money. This tax season, of course, is a little different, not only because of the shutdown, but also because it is the first tax filing season under the tax reforms and tax cuts enacted in the Tax Cuts and Jobs Act. A lot of work has gone on to get us here. Treasury and the IRS have been working diligently and swiftly to ensure taxpayers have the information that they need. In a little over a year, they have put out 16 proposed regulations, 2 final regulations, 45 notices, 21 revenue procedures, and updated countless forms, publications, and other guidance. All of this geared towards implementing the law and addressing taxpayers' questions. Right out of the gate, Treasury and IRS went to work updating the annual withholding tables so taxpayers could immediately begin seeing the benefits of lower taxes in their paychecks. Now, of course, whether a taxpayer had less or more withheld from the paycheck is not the final word on whether one received a tax cut. Also, due to changes in withholding, a smaller or larger refund than usual may not tell the whole story. I encourage taxpayers to compare their 2019 tax return with that of the previous year to see the difference. Only then will they be able to be absolutely sure whether it benefited or they didn't benefit from the tax cut. At the end of the day, the vast majority of taxpayers will see that less of their hard-earned money is going to the government. A chief priority for the new withholding tables was, of course, accuracy. Extensive analysis was done to help taxpayers get the right amount withheld from their paycheck, not too much, not too little. However, as we all know, no withholding table will ever be perfect. Every taxpayer may be affected a little differently under the new law based on their personal circumstances. The IRS continues to consider whether future improvements to the withholding structure may be necessary, which I support and will be monitoring as chairman of the Finance Committee. The IRS has also embarked on an extensive campaign to alert taxpayers to check and update their withholding. This included establishing an online withholding calculator to help the taxpayer determine what, if any, adjustments to their withholding may be necessary. That said, there's still going to be some taxpayers who may discover that they were underwithheld due to changes in the law and owe tax at the end of the year. A subset of these taxpayers could be subject to a penalty for underpayment. The ranking member, Senator Wyden of the Finance Committee, raised this concern in a letter to Commissioner Reddick on January 3rd, requesting that penalty relief be granted. I generally agree with the ranking member and have encouraged the IRS to be lenient on penalties, especially with this first time through the filing season under the new tax law. If a taxpayer is underwithheld as a result of the changes in the law and not through the fault of their own, the IRS should consider what action the agency can take to provide penalty relief. But the issue of underwithholding due to the passage of tax reform should not be exaggerated. Yes, as the ranking member claims in his letter to the commissioner, it is estimated that as many as 30 million taxpayers may have had taxes underwithheld from their paychecks. But what hasn't been said is that 30 million is actually only about 3 percentage points increase from how many taxpayers would be underwithheld under even the old law. Moreover, just because a taxpayer was underwithheld during the year does not automatically mean that they will be subject to a penalty tax. Safe harbors have long been in place to protect taxpayers whose withholding is slightly off from being penalized. It is quite possible that some issues will arise this filing season that we did not anticipate and will need to fix as we go forward. We already identified a number of those issues, which I'm hoping my Democratic colleagues will allow us to fix to further help as many more constituents as possible. But that doesn't detract from the fact that we have delivered real tax relief to middle-income families, small business owners, and the family farmer. Nor does it undermine the fact that we modernized our outdated international tax system and improved America's business competitiveness in the global economy. And of course, that's going to benefit the American worker. These efforts have contributed to a strong and growing economy. The unemployment rate is at a half-century low. Wages are rising at the fastest rate in nearly a decade. And workers, employers, and small business owners are all more optimistic than ever. Unfortunately, I hear increasing calls from the new House majority pledging to erase the progress made with the tax cuts and reforms that we enacted 13 months ago. At least one new Democratic member has suggested bringing back top tax rates as high as 70% to pay for a wish list of far-left big government programs. Such a confiscatory tax rate targeted at a relatively small number of wealthy taxpayers would barely make a dent in the cost of programs that they wish to implement. Policymakers across the globe abandoned such punitive tax rates over the past several decades for their negative effect on economic growth, investment, and incentives to work. While tax rates at 70% or higher may have been fairly common in the 1960s, today not a single OECD country boasts such high rates. How soon people forget about the prolonged economic stagnation and high employment of the 1970s, when we last had tax rates as high as 70%. And I'm going to detract here to show a chart, but how soon we forget that just raising tax rates doesn't automatically bring in more money. Now, for the benefit of my colleagues, but for the benefit of the public watching on C-SPAN, I should have had this blown up, and I doubt if it's going to do much good for me just to hold up a small sheet of paper, but this goes back to the year 1954, ending this year. The blue line shows the marginal tax rates over a period of about 60 years. You can see high tax rates in the 60s, going down, up, generally down, staying pretty low in recent years. But you can see the red line is the amount of money that comes in from taxes, whether you have high tax rates or whether you have low tax rates, which kind of tells me that the taxpayers are a lot smarter than the Congress of the United States. Because when you talk about high marginal tax rates, they want you to believe more money's going to come in. And they are probably going to take a position, if you lower tax rates, less money's going to come in. But you see, at 70%, well, let's see, what is it? No, the top rate here in the 50s was 90%. Can you imagine Americans being dumb enough to work hard to only keep 10% of their income? No, what you do is you change people's behavior. They decide, I'm only going to work so much. Why should I work harder and give more money to the federal government? So you see, higher tax rates don't do what a lot of people want you to believe that they're going to do. So I just got done reading about why would you want to go back to those years of stagnation, pessimism, and joblessness that we had up to the 70s, when we had even reduced from 93% tax rate down to 70. I'd like to give a little history on this, because you kind of think that if we have lower marginal tax rates, and Republicans are the ones that want lower tax rates, that you would give Republicans a lot of credit for reducing these marginal tax rates. I can remember the work of a Senator, Bill Bradley of New Jersey, probably at least a moderate Democrat. He was probably as responsible for anybody in the 1980s to reduce these marginal tax rates, because Republicans didn't have guts enough to do it. Or we might not be where we are right now. So it's not just Republican thinking, that got these marginal tax rates down. It's not just Republican thinking that has kept this red line where it's been for 60 years, approximately 16 to 20% of gross national product, the amount of the economy that's coming into the federal government. So I hope the talk of such confiscatory taxation truly is the talk of a few rogue members and not representative of things to come. I would like to think that there will be opportunities for us to work together in a bipartisan way. I'm firmly in the camp that tax reform and tax cuts enacted by the last Congress represent important revisions to our last tax laws. But I also understand that no major piece of legislation is entirely perfect, and to the extent there is legitimate interest in improving tax laws, as chairman of the Finance Committee, I'm going to be all ears. When it comes to making modifications to tax reform, our first order of business should be focused on examining how the law affects individuals, families, and the businesses in our state that provide jobs and benefits that they rely on. And when necessary, we should work together to take action and ensure the law is fulfilling its potential. A key part of this decision should be enacting technical corrections to the tax law, revisions to ensure the bill does what members thought it did when they voted on it, and some of these are related to just poor drafting, honest mistakes that were made. I also hope that there would be plenty of opportunity to work on a bipartisan basis on tax issues involving everything from education to renewable and alternative energy to consumer-directed health care options. However, I fear opportunity to work together could be put at risk should my colleagues become fixated on tearing apart tax reform, hiking taxes, and, of course, going after the president's tax returns. I want to put my Democrat colleagues on notice that I have no intention of undoing structural changes implemented as part of the tax reform. This would include the lower tax rates and family benefits like increased child tax credit and standard deductions, nor am I interested in eliminating the cap on the deductibility of state and local taxes or backtracking on our move towards a more territorial tax system. Raising tax rates on pass-through business owners and farmers or corporations, all of which provide critical jobs and contribute to economic growth across the nation, and for the first time in probably 40 or 50 years, made our businesses competitive with the rest of the world. When we have a 35% tax rate like we did for years and years or decades and decades on corporations, and the world average is about 23%, how can you expect American corporations to compete? We're now at 21. It wasn't long after we passed 21 that we read about China maybe feeling that they were uncompetitive and going to have to lower their tax rates. Other countries are thinking about doing it as well. Just like the Reagan tax cuts of the 1960s, of the 1980s, United States is plowing ahead, setting a standard for the rest of the world, lower tax rates, with the business and the individuals making decisions on where they earn their money, how much they're going to spend, how much they're going to save, is a heck of a lot better than 535 members of Congress making that decision, because when we make decisions about stuff like that, they're political decisions. When most of the individual taxpayers and the corporations of America taking decisions, it's strictly economic and does much more economic good. And another one that I don't want to have messed with is efforts to weaponize the authority of tax rating committees to access tax returns for political purposes. Such an action would be unprecedented. Maybe not so unprecedented considering that Nixon used the IRS to go after his political enemies. That's why we have Section 6103 of the tax code to protect the privacy of the tax code. Mr. President, I'm optimistic that we can continue to make progress helping Americans improve their life by keeping more of their hard-earned wages, taking the chance of starting a new business, or continuing to expand an existing one. In short, building an opportunity economy. I invite my colleagues to join me. I yield the floor.